Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Go across to the SBI presser.
Elements need to be kept in consideration. But otherwise, the performance of the bank on all fronts has been very satisfactory. NII is up by 23.81%. But if we exclude one-time impact of recovery in two major accounts, the increase is 12.85%. So there is a growth in net interest income. The NIMs have improved. Domestic NIM is now 2.95, which is up by 27 basis points. But again, if we exclude one time item, then still it will be around 2.8. 2.78, 2.8, around 2.8. These are all I'm giving just approximations. Other income is up by 27%, and this is excluding the treasury. Because of the yield movements, there has been some negative growth, and there was a switch from AFS to HTM. So that impact of nearly 2,000 crore is appearing in the above the line profit figures. So overall performance, if we look at, it has been a very good quarter, I would say, but for some of these variables. Asset quality, which is the favorite, always I say, of the media. So there has been again a very good recovery, I would say. The non-performing loans have reduced by 10,587 crore. There was a recovery and upgrade of 14,856 crore during the quarter, and last year for the whole year this number was less than 14,856 crore. This is of course helped by as I said, that recovery in two large accounts, but the GNPA ratio is now 10.69 as against 10.91, and net NPA is 5.29, which is again a function of increase in PCR, and fresh slippages is 9,984 crore. Many of the accounts, even if after classified as NPA, are operating accounts. Even service standard accounts are NPA accounts, but we don't stop operations in those accounts. Because of that, in the existing accounts, there has been an increase of about 4,400 crore. So that's why that the number looks at around 14,500 crore. But I think the number which needs to be looked at is the fresh slippages, which is very much in accordance with the guidance which I had given at the time of the year-end earnings call, that our fresh slippages will not exceed 2%. So it comes to 1.95%, and the variation in outstandings in respect of the existing accounts will always be there. The credit cost has come down to now 2.55%, and again our guidance was at around 2%. So we are very much on that target. As I said, that first quarter we have made some aggressive provisions to increase the provision coverage ratio. That's why the credit cost looks elevated at 2.55%, but there is a huge improvement as compared to the previous quarters. The growth in domestic advances is 7.25%. The overall growth is lower because of two factors as far as the international banking book is concerned. One is on account of the buyer's credit which were being given against LOU. So there is an impact of almost about 45,000 crore. And we carved out a subsidiary in UK, so another 10,000 crore has been transferred to the subsidiary in UK. So again, the growth performance as far as business is concerned, and particularly on the advances side, has to be viewed in light of the international banking book, where these two have impacted. On the liability side, the CASA franchise and particularly the savings bank franchise Again, a very good growth. The savings bank deposits have grown by 9% YoY. Again, this performance has to be viewed in light of the fact that last year after demonetization the growth was 27%. So if we average out, then it becomes almost 15 to 16% annualized over 2-year period, and savings bank deposit for the first time for the bank has crossed 10 lakh crore figure. So not a mean achievement to have that kind of savings bank growth. And overall, the CASA has gone up by 69 basis point year on year basis. All our subsidiaries, they continue to perform very well. And as I said, that be it the growth, be it the asset quality, be it the strengthening of the balance sheet, which has been the strategy, that rather than focusing on what the quarterly numbers look like, the emphasis has been on strengthening the balance sheet. And if you compare as previous year YoY, the provision coverage ratio has gone up by nearly 900 basis points, and without OCA the provision coverage ratio has gone up by 1100 basis points. So it is now the provision coverage ratio is 53%, and if you look at the corporate book, if we look at the provision coverage ratio for NCLT, so they all are now in a position where overall book we are almost aligned what we call the loss given default. So our PCR is now fully aligned with LGD as far as the corporate book goes. And NCLT 1 and 2 definitely we are sitting on some surplus. NCLT 1 we have provided fully for all accounts as per what was required by the regulation, as well as in line with what is the estimated recovery. And one account alone, we are expecting that as and when it gets resolved, the bank will get almost 4,000 crore recovery. That is the estimate we have. NCLT 2, we have a provision coverage ratio of now 79%. So that itself, even if presuming that the recovery will be 30%, even then we are sitting on a higher provision as far as NCLT 2 is concerned. So whatever angle you look at, the provision coverage ratio or what could impact the earnings in the coming quarters, all has been absorbed by June. On the asset side, again in September, we intend to further improve the provision coverage ratio, so that from December onwards there will be no looking back, and there will be no hangover of the past credit costs. So that is where the entire strategy is around, and this strategy is yielding very good results for the bank. So these are my opening remarks, and open to questions.
One by one.
One by one,
Sir,
please.
how many of these, good afternoon,
Yeah.
from BTVI. So how many of these fresh slippages came from the watch list, if you could give us an idea?
91%.
90%. And the ones that came from outside the watch list, can you
This
give us
is just very nominal. 9%, so you can take 1,000 crore outside watch list.
See, out of this 9,900 crore slippages, corporate slippages are only 3,704 crores. That's a very small number, and 91% is from the watch list. This 3,700. The rest is retail slippages, agriculture, SME.
Yeah, and first quarter always the retail is elevated. Going forward, the retail slippages will come down, and first quarter in agriculture particularly, it is all in the state of Maharashtra and Karnataka. Everything. So basically, I have in mind that some of the power assets, 7 of them, so we are trying to resolve in within this month, or you may say within this quarter. So when that happens, then your provisioning gets advanced. If it is in NCLT, you still get 9-10 months to provide and whatever is the final outcome. But if we resolve them, then whatever is the gap between the provision held and whatever is the estimated recovery, so that will need to be provided in September quarter. So that's why, like I'm saying that, yes, absolutely. The PCR, if you look at the corporate book level, it is, as I said, that it is aligned now with the loss given default estimates. So we don't have to. But still, as I said, that power sector, because we are in very advanced stage of resolution, in respect of these assets, we have the clear idea that what are we going to get and what is our provision.
Fair to say that there would be no incremental provisioning going forward, be it for the stressed power assets that you pointed out?
For stressed power assets, it will be, but I am sitting on surplus in certain assets. So that's why you have to look at the portfolio level. If you look at the overall portfolio level, there is no sort of any additional burden. Normal slippage, normal provision goes up because of two reasons. One is the aging provisions and one is the security if it gets diluted. It is not for the bank. It is the figure is about 3,500 per quarter, and this is there are account specific provisions. So power, if I resolve 7 accounts and if there is a gap, that gap I will have to provide. But there, as I said, that I am sitting on excess provision as far as NCLT 1 and NCLT 2 is concerned. So there may be timing difference. Suppose I get the resolution for the account which I am referring to in this quarter, then it will offset my entire provisioning requirement for power. But if power in any case, because we are resolving, so I have to provide. It may so happen NCLT 1 may happen next quarter. So we have to keep that timing difference in mind. But overall, we have to look at the picture for the whole year. That's what I always say. That don't go on quarter basis. That is not what I look at. What I am looking at is what will happen during the year. And if I look at what will happen during the year, the requirement for provisioning on account of the NP account or the legacy NP account, we have now largely taken care of. Yeah, Ritu, can you use mic? Yeah.
So I just wanted to know, you said you were going to be in touch with the regulator to extend the deadline for resolution for these power assets so they don't have to be sent to the NCLT. Have you heard from RBI yet?
No, we have not approached yet.
Why is that?
So if I don't need to, then we will not approach. If something happens before 28th August, so there is still time. So we will approach if required. But if we can manage without approaching, I will do it without approaching.
So do you have an outlook on the power assets that you refer to? You said that there may be a gap provisioning and therefore you will have to provide. Do you have an estimate of
Absolutely. We have the, because these assets for State Bank of India, they are about 17,000 crore. I have already provided about 40% on the power assets. So if you look at our estimated recovery on these assets is 50%. So my estimate is that for this 17,000 crore, the requirement will not exceed 3,500 to 4,000 crore. And that is what we expect to recover from NCLT 1 account. But timing difference, as I said, all the provisioning, or what I call all the pains, all the blows, we are taking upfront. And we are not leaving anything for the future earnings. We should remain protected against whatever is the past. And that is where we have advanced quite a bit. And in June, we have almost covered our flats.
Last quarter, you mentioned that you would be lending a helping hand to some of the banks which are facing PCA. Now, this quarter, you've seen some growth on the corporate loan book. Is a lot of that coming from there, or are you also pushing your own?
No, growth is largely still coming from retail, but we have a fairly good, robust pipeline as far as the corporate is concerned.
What I wanted to know is that from the PCA?
No, not exactly. As far as this growth is concerned, I don't think there are any takeovers from the PCA bank as yet. But if any customer approaches us and if we are comfortable with the risk profile and we are comfortable about the future of that particular enterprise, then we don't mind or hesitate in taking over some of the loans from PCA banks if they are unable to help in those particular accounts. But as I had mentioned earlier also, it's not with any intention to compete or take over those loans. It will be, if necessitated, by the client requirements. But ultimately, it would also depend upon that how much comfort we have on a particular client.
Speaking of the corporate sector, where exactly are you seeing demand trickle in from any particular sectors? And if you could give an idea of what the pipeline looks like in terms of projects and even in terms of investment that is being lined up?
A lot is happening. You are aware that NHA itself, we have sanctioned a loan of 25,000 crore. So that money definitely flow into the road sector. And similarly, there are many central government undertakings which are in the market for borrowings. And they